From this point onward, we can go on. Like, what were we talking about? The first, so the first thing will be like we have even before going to this level under which regime the company falls, as we were looking at, like this entity information. Now, you have to remember what we are doing is, we are these will be later on PPT slides. These will become PPT slides. Like, first thing is, if you entity information. Now this entire thing is like entity information. In that, what are we saying? Legal status of the entity, right? Uh, sh- Pattern of shareholding, right? What is the who are the shareholders, right? Uh, in the pattern of shareholding also, we can look at the uh, so these are so many different sections that are going to come, right? So, like, through these we can start connecting. Like, for example, if we're saying that what is the legal status, it can be an LLC, it can be a sole establishment, etc., right? So these we can write, right? Pattern of shareholdings. Why do we need to address pattern of shareholding? That's the question, right? So in the pattern of shareholding itself, what are we looking at? Um, we first of all, it will give us all the names of the shareholders, but then we will have to identify a related party shareholders, right? So that will give us an information about residential information of the shareholders. Why? Because from poem perspective, we'll find out. Okay. Now, legal status. When we say legal status, more questions come into play. Uh, for example, is it a foreign company which is UAE tax resident, right? This we can check. It can be a tax resident. It is a foreign company, but so basically, what when we are talking about, we say that, entity information or taxable person information is the better word, right? Taxable. So even before this, then we need one more information. Do you know what is that? We have to say uh, group structure, how many entities and businesses. Why two separate things? It is possible that there is a business but no entity, right? How many entities and businesses, uh, geographical footprint. Why? Because it will reveal uh, PEs, permanent establishments. Maybe they are doing business somewhere, but हाँ, correct ना? F foreign permanent establishment, FPEs, especially FPEs. If local it is there, we'll find out. But what about outside UAE? So geographical footprint will reveal that automatically. Okay, we found out how many companies are there. We found out where they are operating, what different legal status is there, right? Body corporate or not, etc. Acha. We can also find out about, for example, if there is a foreign company, pattern of shareholding, right? But even before that, actually, or uh, here we can write one more thing. beneficial owners of the uh, group. Okay, simply let's call it taxable person, right?
But that's similar to pattern of shareholding.
Is it? That's the key. That's where, that's why we call it tax strategy or tax impact assessment. Do you really think that it will always be the case that the shareholders will be the beneficial owners? Otherwise, why would the beneficial ownership law exist? Proxy shareholdership. Okay, really. Um, where did I write? Beneficial owners of the taxable person, uh, and whether proxy shareholders exist in any part of the world.
So, Altaf, how will we get this information
We
about
will
it?
ask them.
Okay, ask him. Yeah, because according to the MOA, we cannot get these data.
Oh, obviously we will not, but that's a question that we have to ask. Unless we have the information available, how will we be able to identify the risk? Getting the point?
Yeah,
So
understood.
this information we will take. Now they give the information or not, it's their call. We will ask, right? Then pattern of shareholding also we have found, right? Pattern of shareholding, including proxy shareholders. Okay. Uh, Exists in any part, including UAE, any uh, trust deeds signed with proxy shareholders, right? So that also we will ask. Okay, related party shareholders also we talked about, right? Related. What is the meaning of related party shareholders? Related party, natural person. Uh, Actually, it's not restricted to natural. Uh,
Legal person.
okay, so with related party shareholders, whether natural persons or juridical persons. This also we will find. What different shareholders are there? Are they related at all or not, right? Acha. Then we talked about the residential uh, information of the shareholders from poem perspective, right? Uh, so yeah. So m- until now we were looking at the overall structure of the entity, their corporate structure, their shareholdership, everything, right? So once we have this information, and then immediately some other things will come into play, like the major regime question will come, right? Like under which regime do they fall, right? So we have different regimes, right? We have Article 3, which is norm. By the way, we always used to call it normal tax regime, but the word is standard tax regime,
Tax rate.
right? Uh, or qualifying free zone person regime or top of tax regime, right? So that we,
Geographical, we only mentioned the foreign companies, right?
geographical what?
Geographical footprint.
Entire group. So naturally it will be like
Can you just go up? I think we mentioned okay, fine. Yeah, foreign. Okay, it's
by
fine.
geographical footprint means wherever you are, UAE, out of UAE, everything, right? Uh, or CFCs. You know what is CFCs? It's a big issue in the poem.
Okay. So,
CFC is a major concern cited by international tax, OECD, etc. Okay, so we have to identify if there are controlled foreign companies. Okay, okay, so we have to now look at the regimes also. Like, is it by default, every company is under standard tax regime, right? But even before that, we should, quickly raise this question.
if there is exemption.
Spec- Specific exemption, right? So, is the company, does does the taxable person qualify for specific exemption under Article 4 exemption regime, right? So what we know, too many different you know specific exemptions fall into play, right? So like when we say a company is, it seems that it is meeting the criteria of one of the exemptions granted under Article 4. Uh, then different types of exemption are available. Which exemptions are those? We can look at the decree law. These are the entire. So from Article 4 until Article 10, you will see that then they will continue to talk about so many different things.
Exemptions applicable, like these are the, this is type of person, right?
So as I said, as I've said it a number of times, the way UAE corporate tax impact assessment works is we do not look at transaction level at the first instance on the first instance. What we look at is the taxability as a person. We don't go to account level, P&L level. No. First thing is we have to look at the person. So from if you look at all these articles from 4 onward, so like this is first article, right? In this it gives all these types of persons who enjoy specific exemption, right?
Yeah.
Government entity, controlled entity, government controlled entity. Then we have extractive business, non-extractive. Then we have qualifying public benefit entity. This is also an exempt entity, right? Qualifying investment fund. Then we have pension social security fund. Then this is related to all the above. Juridical person incorporated wholly owned subsidiaries of some of the above, A, B, F, G, right? So AB is government and government controlled entities. F and G is different, qualifying investment fund and pension fund, right? So AB, FG, right? So if it is a wholly, but again, some more conditions are there. Undertakes part of whole of the activity, engaged, all of these. Anyways, now these are elaborated from section 5 onward, if you look at it. More things are mentioned in this section, we can look at it, but 5 onward they are detailed, like what type of exemption is enjoyed by government entity. There are exceptions within this exemption, like government entity by default is exempt, but if it conducts a business under a license,
Is issued by a license.
then it is then that operation is taxable. Even that operation will be treated as an independent business, and transactions between the related parties, between exempt person and the taxable person, it will be seen as same kind of a rule applies for government controlled entities. Same rule applies for extractive and non-extractive businesses. Like they are by default exempt, but if they are doing uh, so like that, it goes on until non-extractive. Now, these first 4 categories, government controlled entities, extractive, non-extractive. After these 4 broad Then the next thing that comes in is a different. Now these are like slightly different. Qualifying public benefit entity. That's it's an entirely different exemption, right? So the conditions have been mentioned here. So it has to be all welfare, this, that, mandate has to be there, charter has to be there, etc., etc. Right? Then qualifying investment fund. Now uh, these are funds, investment funds. Why? Because they deal usually with the passive income. They provide passive income to the investors. That's why a specific exemption has been granted here, right? So again, regulatory oversight should be there. This, that, all the conditions have been mentioned in the qualifying investment fund also. Now questions will come. What is the fund status? Is it itself a legal entity? But even if it is a legal entity, it will still enjoy the benefit.
The juridical person.
Huh. So then until 10, basically, the exemption regime stops. There are certain more things that we will see later, but that I will write here. Okay. So exemption regime. So I'm just going to mention here articles 5 to 10
Article 4 to, okay, 5, yeah.
detail the exemption provided in Article 4, right? So basically, what we have covered up till now, we started from Article 3. Article 2 is only the scope article, but Article 3 provides regimes. We covered Article 3, we covered exemption, right? But is that it? Are there any other exemptions that are hidden inside the corporate tax law but we have not addressed? There are. For example, tell me.
The small business regime.
No, that's not an exemption. Small business relief, okay, that's, you could say it's a tax holiday. Yes, agree.
Uh,
Okay, let me write it here. Small business relief, it's, in a way, it is an exemption, temporary exemption, right? So small business relief will also be relevant here. What does that mean? That by now we should have at least the overall revenue information,
yes.
correct? Uh, So, anyways, so I'm going to write it here. So, for a small business relief, naturally we require revenue information. Any other reliefs have been provided that, or exemptions?
Exemption.
Which one?
Participation exemption.
No, but that's an account level exemption. We are still at entity level. Participation exemption is the second phase of the impact assessment. First thing is small business relief. I'll tell you Article 14.
Yeah, it's a foreign permanent establishment exemption. That is also established.
We can write it. What is the article number?
24. It was one
For
last.
just first of all, check Article 15, I think. Check investment managers exemption for a permanent. Which article is it? Permanent establishment exemption, right? This we have to check. What is the investment managers exemption?
Article 15.
15, na? So I remember the entire corporate tax law. Don't worry. Okay. Where is that? Investment managers exemption, right? So that is Article 15. For FPE is Article 21, I think. Foreign permanent establishment, right?
24, yes.
Huh?
Yes.
Article
24.
24.
Yes.
Are you sure?
Yes, 24.
So what is, okay. No, 24. Okay. So Article 24, small business relief, what article?
21.
Article 21. So, okay. So basically, uh, and one more exemption that might be hidden from eyes is the reciprocal exemption of international transportation. So, yeah, aircrafts and all.
Maybe I think 40 something.
I don't know what was that. International
But Mr. Alta, that is exempt
not transport. That is Article 25.
Okay. Not this one.
So non-resident person operating ships in international transportation. So this also is a hidden exemption, right? What is that? Article 25,
Yes.
correct? So that if you look at it from a sequence perspective, sorry, if you look at it from a sequence perspective, Article 15 will be for uh, Article 15 for investment managers exemption. Then immediately after 21, which is small business relief. In between, there are other things, but like 18, 19 is for qualifying free zone persons.
But those
16, we should look because I think these are related articles for unincorporated partnerships and then family foundations.
But unincorporated partnership is not an exemption.
No, it is not. That's why I'm not writing. But but it's a different regime, right? Because we still
Yes.
yeah
it is
we
a different
yeah.
regime.
So yeah, 17 is family foundation, 16 is unincorporated partnerships, 15 we addressed, right? So anyways, the point is why we have to ask this question to ourselves, why unincorporated partnerships is one of the starting questions in the corporate tax return. Why? Because this is flow through taxation. Because unincorporated partnership is not taxed by default at entity level. So that was specific exemption, right? Agreed. But by this time, we should also have asked this
But
question.
check the legal status. And under the legal status, we will know if it is a LLC, sole establishment, unincorporated partnership.
But how do we identify which is an unincorporated partnership? That's another question to ask, right? Like somebody comes to you and says, I have a general partnership registered with DED. Will you treat it as unincorporated partnership or incorporated partnership?
It has a license. It's no, incorporated partnership.
It is an incorporated. That general partnership, actually, it is sometimes referred to as a partnership company.
Okay.
The only difference is that the liability of partners is unlimited.
Yes.
It is still a company with an unlimited liability of partnerships. So, the only thing that we can accept or FTA will accept as unincorporated partnership is where the trade license is not there.
Yeah.
And we have signed an agreement or something, a deed, partnership deed, properly signed deed, notarized, everything. It is even notarized, but it was not incorporated with a trade license. So the key factor is trade license. So we have to ask this question as well, and even while doing the corporate structuring review, etc. Uh, is the uh, business an unincorporated partnership, joint venture, trust, trust under DIFC or ADGM, or maybe RAC, ICC, etc. Because these are
Treated as
not,
legal entity.
no, these are not treated as legal entities. These are not legal entities. Mainland trusts are legal entities.
ADG and
I see. Just yesterday, I've written an article on LinkedIn. I don't know if you've seen it or not, but
sorry, or no, I have to read it.
so anyways, it details the DIFC, uh, you know, DIFC treatment. like, so I'll share this thing uh, for your knowledge. Too much, there'll be a lot of information within this one link itself. Uh, so if you look at it,
Trust on.
if you go into it, it will clearly identify DIFC. Interestingly, in DIFC, it sends you to the England and Wales law. It says the whatever is provided there, it's the same. And I even did the research in UK trust law. So even in UK trust law, legal personality has not been awarded to trusts. They are still treated as unincorporated partnerships. Okay. The only place in UAE is the mainland. Okay. Anyways, I'm coming back to the things that we were.
So not if it is incorporated in mainland, but even the activity also plays a role, right?
It, yeah, it will, but then that trust will not be akin to an unincorporated partnership, right? Because it is now incorporated. So any trust that assumes a legal personality, it becomes a body corporate.
Mm.
Then we cannot ignore, because then it is no longer an unincorporated. The default treatment provided in corporate tax law is unincorporated partnership. Now, this nomenclature, unincorporated partnerships, can take many different other nomenclatures. One example is trust. In DIFC, in ADGM, in similar other places, wherever trust structure is provided, it will be taxed in line with the unincorporated partnership thing, right? It can be a joint venture also. Anything, even a verbal agreement. But the point is,
So that now like the in focus, it's actually a LLC. But if you see their MOUs or articles of association, they are not named as shareholders. They call them as partners, right?
yeah, so that's a normal thing. That's even provided in the company law. You'll be surprised.
Is it
Open the company law of UAE. Federal Decree number 32 of 2021. And you will find the words partner written inside there under LLC. So when the law is saying that,
so
everyone can say that, right? Anyways, the point is that I've addressed unincorporated partnership. Um, I'll one more thing we should remember. Uh, Family
foundation?
foundations are also taxed as unincorporated partnerships. This also we should remember. See, when we look at the partners in unincorporated partnership, this is 16, right? But have a look at Article 17. Let's see what it says. Can make an application to be treated as an,
Unincorporated partnership.
there you go. But again, we should remember that the options will also be relevant here. Um, Option to be taxed at entity level is relevant here. That also we need to consider. Okay, what was, where was this mentioned under Article
Article 16.
16, right? So, anyways, this is all about. So here, almost we are finishing up with the taxability as a person, right? So, specific exemptions even we checked, right? What else? We even checked foreign permanent establishment matter. Acha, we at this point, uh, the we can put it in the regime also, so that's not a problem. Like, which regime company falls in, right? So one was standard regime, then we should segregate it actually. Okay, so we can mention that this qualifying free zone person regime is relevant here, right? Now there will be too many things under qualifying free zone that's a big thing. Right. So under the qualifying free zone person regime, then those you know CD 100, MD 265, and the corporate tax guide, all of these will become relevant. Or even corporate tax guide we will have to refer to in this to ensure. Now we have to remember the concepts that are provided in qualifying free zone person regime. So can you repeat, give me broad level recap of what would be qualifying free? What are the caveats that we will be looking at it?
First of all, the registration, there'll be a free zone person,
First thing will be that it will be a free zone person.
then qualifying income.
But if can it be a natural person, qualifying free zone person? In free
It's
zones,
a legal person.
it has to be a legal person, cannot be a natural person to begin with. And the interesting part is that if we look at the various structures provided in free zones, none of the structures gives a sole establishment option, to my knowledge. Maybe I'm wrong. Maybe some, free zone may give this structure, but to this day, I have not seen any single free zone give a sole establishment or sole proprietor status. They have something called FZE,
Yeah,
which is called free zone entity in multiple free zones. And this was a doubt initially created, but no longer is it a doubtful question.
it's like
FZE,
single
single owner LLC. So that free zone entity it is crystal clear now. We've gone through the memorandums multiple times. It has been discussed. FZEs are juridical person. They are not natural person, right? So the chances are very minimal that we will encounter this in a free zone. By default, any free zone person that comes to us, chances are it will be a legal. But the main the diligence is that we have to look at the memorandum.
Mm.
Always review MOA or AOA, memorandum or articles, to confirm juridical person status, right? That's the given, or so meaning asking for the information for memorandum association is a bare minimum must. Memorandum and articles have to be seen. There's no escaping it. Acha. Having said that, now let us do a quick recap.
then we have to identify the qualifying income,
Okay.
whether it's qualifying activity.
Okay, let's do it this way. Wait, let's do it this way, because this is a kind of a work program that we are doing, right? So we have to ensure that tomorrow you guys can quickly relate to it, right? So Article 18, what does it say? Like within the Article 18, how many conditions have been provided? 5 conditions,
I don't know, like,
right? There are if you look at Article 18, you will see 5 conditions provided under Article 18. These are those A, B, C, D, E. Now, apparently, these are 5 conditions, but the last condition, E, any other conditions, this one sentence opens another Pandora box. So these no longer remain only 5 conditions.
it could elaborate.
There are other conditions, other so many different things that will come because of this one point. So what are those key conditions? Are very easy to remember. Substance should be there. Qualifying income should be there. C is a, yeah, that Article 19, right? Option. So Article 19, we know what it means, right? Option to be taxed under what? STR, right? So that if you are not taking the option, we should put it as stop, right? As the first thing. Even before looking at Article 18, first we should look at 19. If they've opted, everything is gone. Then start the Article 8, 5 conditions provided. Um, Clause E opens the review of CD 100 and MD 265 because of clause E, which is it? Which is it? Let's have a look at it. So 1 18 1 E. So basically, what we're saying is Article 18.1.E, right? opens the opens the requirement to review all of.
So that uh, clause E and also clause B, because clause B we have to redirect CD.
Correct, correct. Yes, yes. Uh, B and E, right? So they open the Pandora box of CD 100 and MD 265, right? Fine. Uh, so that means now we have to also, you know, address these separately, right? So what does the CD 100 says? What does the, sorry, uh, what does the MD 265 say? And is there a need to go into CT corporate tax guide at all? Right? So anyways, we can uh, write this on top. Always look at the memorandum. Fine. उसके बाद हम we immediately go to Article 19. Then we go to Article 18. We read key factors of Article 18, but then we went on to the detailed one, which is CDN. Any other thing in Article 18 that we should be looking at? Fails to meet, no, minister may prescribe. These are like all, generic. Qualifying income to apply for the remainder of the tax incentive period stipulated, etc. Nothing. So, what is this? Free zone person shall apply for the remainder of the tax incentive period stipulated in the applicable legislation of the free zone in which the qualifying free zone person is registered, which period may be extended in accordance with any conditions as may be determined in a decision issued by the cabinet or the suggestion of the minister. But any one period shall not exceed 50. Yes. So what they're saying is that this qualifying free zone person benefit maximum duration is 50 years. This is a maximum 50-year regime. Beyond that, then the person will not be able to enjoy qualifying free zone person status, right? So that's a general thing. And I think this 50-year thing was given because of the previous actions being taken when they were opening all those free zones where the within the constitution of the free zone it was written that for 50 years there will be no tax for 50. So just to honor that, this 50-year thing has been put in place. But anyways, um now we have to start looking at CD 100. Okay, fine. So where is the CD 100? Let's have a quick look. CD 100. That's it. There you go. So a quick recap we have to, because we have to quickly write these things so that we are able to uh, remember quickly. So what are the key things of your mind that you can remember? What is the most important first thing that comes? Article 2 or Article 3? Article 3. So the first thing that this decision has is Article 3 defines
The qualifying income.
categories of qualifying income, correct? How many categories can we think of? Four categories?
Yeah, yes, yes.
Hmm? So by now, so much discussion has happened that it should be easy for us to remember. First scenario is free zone to free zone. Second scenario, free zone seller, non-free zone buyer, right? Third scenario, uh, it's a unique one, exploitation of qualifying intellectual property. This was not there in the previous version of this decision. So, but anyways, last one is de minimis. Satisfies the de minimis. So, what does this de minimis mean? The first three ones, okay, fine. But simple concept of what is de minimis?
There's a percentage, uh, I think 5%.
5% of the total revenue or 5 million dirham, whichever is less. Whichever is less.
That's the
5% of the total revenue or
5 million.
5 million, whichever is less. That's the de minimis criteria. I don't know if they have written it here itself or they again alluded to MD 26. I think yes, MD 265. So they've
MP265 is regarding the activities.
yeah, but the last part of this MD 265 is it addresses the de minimis as well, I think. Uh, Let me go to the last part. There you go. There you go. 5% of the total revenue, or
5 million.
5 million, whichever is lower. See, so the answer is divided, right? So let us go back here. What was the thing? Defines categories of qualifying income, uh, including de minimis threshold, right? Including de minimis threshold, without specifying the amounts, uh, which are provided in MD 265, right? So that's for the de minimis, right? Um, so just a quick question, like free zone person free zone seller will enjoy qualifying income in if he sells to any free zone buyer. Am I right? That's the first scenario. Will he enjoy this qualifying income for all types of sales, or some things are
For the excluding
excluded activity?
excluded.
So except for excluded activities, anything that the free zone person sells will attract
Well,
qualifying income. It will be eligible for qualifying income. Am I right? Except for there may be some more exceptions, like in the case of trading business, distribution business, because in distribution there are other conditions provided.
yes, in the yeah, in the Ministerial Decision, yes.
They have specified in case of distribution business, they have specified. For example, what were those conditions? The key condition, if you look at it, materials in or from a designated zone. That was the biggest condition. So if it is not in a designated zone, then it will not be qualifying income in case of distribution. By the way, just to I can't teach everything in this short time, but I can tell you that the structure of the decision is that all these qualifying activities that they've provided up until from A to N, how many are these? A to J is 10, so 14.
13 or 14 was
14. So until J10, so 1, 2, 3, 4, total 14. The interesting, which people ignore, is this N, ancillary activity, right? So it can be a core activity, but for example, in case of Infocus, for example, if they're selling glass, or for that matter aluminum, but there is an ancillary activity where where they are providing some service on that, related to that activity. By default, if you think service is not covered, but if it is an ancillary activity, then it is covered, because it is a part and parcel of the overall package. Core activity is trading of the goods, the aluminium or otherwise glass, right? But the ancillary activity is the service that is provided, refinement or some other thing, or paint, whatever.
But what if that ancillary activity itself is a separate legal person, like legal entity?
That's a very different question to ask then. Then we'll be looking at that separate entity separately. Under corporate tax, you don't look at two entities together in one return unless and until they are either tax group, or there is some other which I cannot think of right now. You can't treat two separate entities as one TRN unless they are formed as a tax group. Or even in case of qualifying group, they will still be considered as two separate entities. Qualifying group will come later, right? So that will be taxed separately then. Okay. So anyways, the structure of this decision is that first they describe all the 14 activities. They also described the excluded activities. But beyond that, from clause 3 onwards, they have then explained those activities. Like if you look at here under clause 3, manufacturing of goods, right? And this is the first activity here, manufacturing of goods, right? So explanations have been provided from clause 3, in clause 3. Manufacturing of goods material includes production, improvement, assembly, this. Processing of goods includes this. Everything has been trading of qualifying commodities. Now, how would trading of qualifying commodities be different from distribution of goods? That's a question someone may ask, because it may be confusing. So the difference is distribution. Trading happens usually on a trading platform or an exchange. That's trading. Trading of, right? This is distribution.
So just as of usually we say normally like the selling of goods and so goods are considered as trading, right?
Yeah, it is. So it is mentioned here. Trading of qualifying commodities means the physical trading activities of qualifying
Okay.
commodities and associated derivative trading used to hedge against the risk involved in such activities. Right. So physical trading activities. Now, again, it to my understanding, actually it would mean using of, for example, DMCC. Yeah, there's a Dubai Mercantile Exchange, right? So if the trading is, and it is physical trading, so you can complete a contract by physically delivering the goods that are traded. It is also there, and as an additional activity, these trading, there are two legs there. One is called the physical leg, the other one is called the paper leg. Physical leg is that you have purchased, or you have sold some barrels of oil. So once you actually deliver it, that position will be closed on the for this trading activity. When you opened this position of selling that oil, and you were worried about the currency fluctuation or the price fluctuation, and you hedged it using a futures or other forward option, that is the paper leg of the deal. So these are two separate legs, and they will exhibit opposite direction. If the price here goes up, the corresponding paper leg derivative that was there, the value of that will go down, and it will offset, and vice versa. So that is included in here, right? But if you look at the
Yeah, there is one more point
hmm,
after yeah, holding of shares and other for investment purpose. How would this like be different from
from
trading qualifying commodities?
yeah, but a huge difference, no? DFM, ADX, Dubai Finan hold on. Dubai Financial Market and Abu Dhabi Exchange deal with securities, shares, bonds, sukuks. These are
Yeah.
securities. Dubai Mercantile Exchange, on the other hand, it deals with gold bullions, silver, platinum, palladium. These are
Yeah,
these are physical commodities. Huge difference. Clear? Huh. So holding of shares is a very different story. So, anyways, acha, wealth, headquarter, treasury, finance, distribution.
case for the holding of what about these the companies like investment management?
हाँ, तो investment management, see, you
Exemption.
used a word just now, holding of shares. The word holding itself indicates something, remember, holding companies.
So only those
So
types.
we are holding of shares and other securities for investment purposes. What does holding company do? This is exactly what it does. Holds the shares of subsidiaries or associates, right? Whereas investment is a different, the investment management activity is a very different story. These companies take in third party money usually quite a lot. They can have their own money as well, but in that case, usually it will become an holding company. But third part, so it would be written here if it is mentioned, but in fund management here, in activities of portfolio management, that's where probably it is covered. Risk management, discretionary, non-discretionary, fund management. So we set up funds, we take third party money in there, we sign a discretionary power agreement, power attorney, and then the fund manager or investment manager, they take decisions, and they either sell or buy or hold. It's their discretion then. So this is fund management. Wealth and investment manager activities have also been defined. We're not going into too much details in here. All I'm doing right now is giving you the structure of how and where to look in case we have a question. I don't have all the answers. I may not have, but whenever I'm faced with a question, I know where to go,
Refer back.
refer back, and where to look for answers, right? So, anyways, where were we? Yeah. So fine, ministerial decision. Now that was decision
That is
100, right? Now we have just looked at the structure of ministerial decision as well.
yes, now.
Yeah.
Practical.
So basically, it was Article 2, I believe, Article 2 that we were looking at. Am I right? This was Article 2. So the entire decision rests on Article 2 if you really think about it. There are other things. Article 3 is de minimis, and here also they're mentioning a detailed article on qualifying intellectual property because this has been introduced.
In CD also.
See, yeah. So this was introduced. So this has been detailed in here, right? And then some other conditions have also been mentioned, like in addition to the conditions, qualifying freedom person must meet its non-qualifying revenue does not exceed the de minimis threshold. Right. There is qualifying revenue, there is non-qualifying revenue. It prepares audited financial statements. Fine. So this a qualifying reason person that at any particular time fails to meet, and then there is the clawback. Any of the conditions the, and, prescribed it sees it will yes lose the personality uh, and for the subsequent 4 years, 4 tax periods. Previously, it was 3 tax periods, I think. Now it is 4 tax periods. So this period in which they lost plus 4 years. So that's all the ministerial decision. So Article 2 is key, and then we have corporate tax guide as well, right? So I will not go into it, but uh, provides more details. So we can look at that guide also. We will need to refer it without, at least once we will have to refer it. Now, this is probably, it will not immediately come in, but because this is for multinational enterprises which exceed AED 3.15 billion annual revenue. So it could have been an M&E. It would be an M&E. But again, if you look at this decision that was mentioned for, uh, M&Es, this regime is effective for tax periods of 2025 onward.
Okay.
Okay. So that we can look at, right? But these were some, so um, I think we've discussed all of these. So and this also. Now, these things, like for example, some exceptional cases that may come. So we have to look at it on case to case basis, like that. Okay. What else is there? Is there anything else that we have written? Okay, a few more things that we wrote. So where does this branch thing go? This is a permanent establishment question, right? So it's a separate topic actually. PE.
Yes.
Okay, so we looked at the regime. Okay, actually, this PE thing we should look at in
We
the.
are addressing it in four.
Yeah, we did address it. We can, include it here. We Yeah, permanent establishment. Now, question is that is it only a branch that can become a permanent establishment, or there can be other modes? Uh, Branch, sorry, as well as other uh, modes of existence, right? In this, if you remember the, uh, I think it was the decision on Formula One. That was a brilliant example. So the company was not present in India, but it had a racing track on which there was a joint venture arrangement or something with another entity in India, but the High Court treated that racing track as the permanent establishment of the UK company, and they taxed it in India. So that's a unique case. So we have to be open-minded. We have to be alert to a possibility that a foreign entity's presence in UAE could still constitute a permanent establishment. This has been given in case of Zatka. Zatka especially identifies separate status as a permanent establishment, even if there is no trade license available.
Sankav, if they don't have trade license, in that case, such permanent establishment, wouldn't it come under the foreign permanent establishment exemption?
Uh, okay, so there are two scenarios we're looking at. Some foreign company is operating in UAE. That can be a permanent establishment
Yes.
for UAE corporate tax purposes of that foreign company. Or it can be the other way around. Some domestic company has a foreign presence in another country. Now, if you really think about it, if it is not a, how do you say, how will foreign permanent establishment exemption be even considered? That's the question we should ask, right? From an FTA mindset, how would FTA look at it? They will, but default, what is the default treatment? Include the worldwide revenue.
Yes.
Am I right? For legal persons, default treatment is include worldwide revenue, including any permanent establishments, foreign permanent establishments, right? But when you try to claim foreign permanent establishment exemption with FTA, what will FTA come back and tell you? Don't you think they will ask evidence?
Yes.
Some sort of a basis? What could be that basis?
That's the incorporation,
That's the,
like legal authority.
what if it is not incorporated? Like in case of Zatka, Zatka has given us a very intelligent work done by Zatka actually. They have given this, uh, you know, uh, status, a separate status they have given, that permanent they use the word permanent establishment itself without the mentioning of the word any trade license or this and that, right? So they acknowledge the possibility of a permanent establishment being there in Saudi Arabia without a trade license. So what if this is the scenario? FTA will ask a clever question, that are you being taxed in that other jurisdiction? But if they are not being taxed in that other jurisdiction, please open the article of foreign permanent establishment. Article 24, right? So we will look at Article 20. This also we should close. Ah, right. Now this is Article 24, right? What does this? There's some very interesting aspects mentioned in here. Resident can make an election not to take into account this. Fine. That's the first thing. That's the general exemption option, right? Now, these are treatments, right? Losses cannot be done. This, that, positive income. Any foreign tax credit that would have been available under Article 47. Foreign tax credit. Uh,
Apply for, I mean, they should have filed it there.
hmm.
But you said they are not taxable in that country.
That's the question. So if there is no tax in that country, then what happens to the foreign tax credit? There is no foreign tax.
Credit from them.
Exactly. So what does that mean? So there are two.
Exemption.
There's no. If they were not at all taxed in there, then hold on a second. I remember this exemption. There was a condition here. Clause 7 of exemption shall not apply to a foreign permanent establishment that is subject. That was the point I was trying to highlight. Now read this point carefully. What does it say? The exemption under clause 1 shall not apply to a foreign permanent establishment that is subject to corporate tax or a tax of similar character under the applicable legislation of the relevant foreign jurisdiction at a rate not less than the rate specified in UAE corporate tax, Article 3. So if the tax rate is less already, that means it is already enjoying there. So this exemption will not even be available. We will need to include it here.
That
The only thing that we will be able to do is claim a foreign tax credit
for this case.
in this case. Exemption we will not be able to take because they are paying less tax than UAE. Now, does it make sense? So that's where were we writing? Uh, so we have to look tax rate in the foreign jurisdiction uh, of FPE, right? What was this clause and what was this article?
Article 24, clause 7.
24.7, right? Okay, so that's done. So we have addressed permanent establishments, also taxable persons. So many things we addressed, right? Is it? If it is aerial, then so be it. And 10. Okay, fine. What else is there? So legal body corporate, we talked about this already. So many, different. Oh, wait, did we? Uh, yes. So this sole establishment will be the first thing to be written there because this is a natural person. LLC, civil company. You see, civil company is not even available in the new version of the company law. This goes to the previous laws that were there, civil transaction law or something. Okay. So very old civil companies still exist. Okay, so this I can delete. Yeah, how do we treat with the rep office? What will be the situation? For rep office, what will be the treatment? We have to understand. Rep office cannot do trading. It can do maximum R&D, market research, etc. Okay, so we decide on the resident non-resident question?
I think we added here resident.
Yeah. So residency is it was we addressed
Yes.
this matter. So here, right? I've just article, and what is article 12? 11, fine. We understood. Uh, 11 was the tax base, right?
Yes. No, Article 11 was a taxable person.
Sorry, yes. 11 was taxable person. So we in Article 11 there were categories of taxable person from a residency perspective.
Article 12 is the taxable.
So meaning if first they define what is resident and non-resident, and then they define how the resident and non-resident will be taxed. Exactly. And where is the state source income? We did not address this. So this is a question, right?
Yes.
So we should write it separately. Like we've mentioned,
I think it will be second because under non-resident only state source income.
exactly. Geographical footprint, FPEs we mentioned. Then we should also address the state sourced income, which is Article 14.
No.
Article 14, huh?
Permanent
Sorry, 13. Article 13. Article 14 was what? Permanent establishments. So where did we mention the permanent establishments here?
We mentioned
This one.
yeah,
So,
Article 4.
actually it is covered there, but anyways,
Yes.
art, Article 14 as well as article कौन सा दूसरा which was the other one 24, right? So two things covered actually. So anyways, so now we've done a clean sweep of article 10, sorry, article 11, 12, 13, even 14, right? Permanent establishment. 15 also we discussed. What was 15? Uh, investment managers exemption. What is the concept of this? Do you understand this?
The agent.
Agent. An investment manager by default will not become the permanent establishment of the investor. Okay. There are conditions mentioned here. Okay. Then 16.
So this, how is this different? Like now, if an investment manager is operating inside a free zone, then it will come under the policy.
No. Okay. Read it. Read it. For the purpose of clause 6 of 4, investment manager shall be considered an independent agent. The whole point of how does PE get formed? There are three different ways, right? One is first is fixed place of business. That's one way of PE being established, right?
The activities have been controlled by the same.
No, that's foreign companies, CFCs, controlled foreign companies. Permanent establishment is when we have a fixed place of business in a country. That's the first thing. Okay. So that means like a factory, installation site, whatever it is, right? That's one category. What was the other category? Now, this category is very interesting. It's not a fixed place of business, but a very authorized person acting on behalf of the principal. It's called dependent agent. That was the second category. Actually, this dependent agent we should mention clearly with clarity. Branch, sorry, dependent agent. What was another form of permanent establishment? Exactly. So here we have nexus was there. So, but in case of UAE, the nexus has been restricted to immovable property only. But the UAE corporate tax law is silent on digital nexus. Have you found anywhere anything written on? Nothing is written. But when law is silent on something, does it mean by default that it will not be covered? No. There can be a digital nexus.
Maybe they have not specified it.
Okay, storing this is all where is the nexus mentioned here? I think it is mentioned in um previous base, I think. This is state.
It is mentioned in permanent establishment.
Okay, yeah, it will be, but it has a nexus. This is article 11. Yeah. So this is taxation of non-resident person. Has a permanent establishment in the state either or derives a state so has a nexus in the state, right? So and they have alluded to a decision. So if you look at decision issued by the cabinet at the suggestion of minister. So there has to be a cabinet decision on nexus. So if let us have a look at the decision on nexus. So there would be a CD cabinet decision. Okay, it will be here. Okay, wait. Let's
Cabinet decision 56.
56 is it? Yeah. So let's have a look at this. See, I have sent you guys.
I downloaded now.
Yeah, download, no problem. Download. It is always available, right?
Yeah.
Nexus in the state. See, non-resident shall have nexus if it earns income from any immovable property in the state.
Yeah.
Right?
Yes.
This decision is entirely based on immovable property.
Yes.
Right? But my question is the digital nexus. My $1 million question is digital nexus. Does this decision preclude the possibility of having a digital nexus as a permanent establishment for a non-resident person? Somebody sitting in China doing business through Instagram.
Yeah.
Don't you think that would constitute a digital nexus?
Yes.
Huh?
Yes.
But it has not been addressed. At least not in this decision. But
It's specified as immovable property.
huh, exactly. So this is all immovable property related. So we have to be extra careful. So so that's what, there are gray areas still in the corporate tax. So we should always look at these things. As a matter of fact, this can be an advisory area for so many people who are conducting business in UAE through digital nexus.
Yeah, okay. It might come up later.
Yeah, it is already here. It's just that it is not written in black. It's not addressing something in black and white does not by default preclude it from the dragnet of tax. That's what I'm saying. Meaning tomorrow a non-resident cannot take a position that since you did not say anything on this, we are out of this. So, but where was that?
In this case, how would they know? Like, first of all, they're outside the country. I mean, it's not even stated anywhere. Even though
When
it
you
mentions
are
that,
in any way dealing with a country, you have to comply with the laws.
yeah, but if the tax law has not specified anywhere, then they would automatically consider that they are not liable for that. They are
Hmm.
not.
That's a gray protection they can take. That's a defense they can form. I agree. I agree. Even if tomorrow someone is sent a notice by Federal Tax Authority saying that you have a digital nexus, you are subject to corporate tax.
Mm.
Let's say scenario, okay? What will be the defense of that person? His defense will be the decree law, this Article 11, Clause 4, Paragraph C.
Yeah.
Their defense will be this. They'll say that you have identified that a non-resident person who is not considered a resident person under the clause and has a permanent establishment or derives state source income or has a nexus in the state specified in a decision issued by the cabinet. You have not issued a decision, any decision that addresses this nexus matter. But FTA will take a counter position of this clause,
Oh, establishment.
that they will say that a non-resident person who is not under this clause and that either has a permanent establishment in the state. Now, question is, can a digital nexus be construed as a permanent establishment in the state? That's a question. Am I right? So that's a counter measure taken by FTA, counter argument taken by the FTA. So to answer this, we have to refer to which article?
14.
14. Let's go to Article 14 and let's read through. Maybe there are grounds, maybe there are not, but we have to see, right? Non-resident person has a permanent establishment in the state in any of the following case, where it has a fixed or permanent place, that's the first category. Where a person has and habitually exercises an authority to conduct business, that's the dependent agent scenario of the non where a person, now look at it, what a beautiful wording, where a person, what does that mean?
It can be a legal person.
Yes, on behalf of the non-resident person. So
Yes.
that's dependent agent. It can be natural person, it can be legal person. Third form, third C, where it has any other form of nexus in the state as specified in a decision issued by the cabinet.
That is immovable property.
Until today, that nexus is restricted to immovable property. So even under Article 14,
Yeah.
the nexus matter has been restricted to this cabinet decision, right?
Yes.
Okay. So I think they will have a very strong case to defend themselves against digital nexus. Uh, okay, fine. The rest of it is, this whole thing that you see. This is a replication of OECD Model Tax Convention area.
They could, I mean, it can just be linked to the state sourced income.
No, I mean,
Because again, if they are performing a service and they're earning income from the state, right?
mm. So let us have a look at the state source income. Yeah, there's a very strong ground for it. Let's have a look at Article 13, state source income. It is very much income shall be considered state sourced income in any of the following instances where it is derived from a resident person. So if somebody has opened a digital nexus in UAE, the probably the main idea is to derive income from resident person. The audience will be here. Chances are clients will be here. Okay, that supports first point supports. Where it is derived from a non-resident person and the income received has been paid or accrued in connection with and attribute to a permanent establishment of that non-resident person in the state. Here, since they have alluded to permanent establishment, that takes you to Article 14, and in that article, digit nexus has not been has been restricted to immovable property. So this does not support. C, where it is otherwise accrued in or derived from activities performed, assets located, capital invested, rights used, or services performed or benefited from in the state. This supports. So there are two grounds, very, very strong grounds to support taxing of a digital nexus in UAE. You agree? That's why I say it is better to inform. And the legal, battle or legal argumentation that we have just done, in my view, it supports.
So that this could go other way around, so, right? What about the UAE influencers or whatever? They are performing in other countries and maybe they are not aware of this.
No, so they are utilizing the UAE domicile in order to do. They're sitting here and doing stuff over there, right?
So they're
For
getting paid
from that source. So it's a state sourced income.
for that.
It's a foreign state sourced income for them, right? So that will come to a different angle then. Then we will have to look at their status. Are they individual natural persons? Because if they are natural persons, they will be taxed under Article 11, natural person. See, this one, a natural person who conducts a business or business activity in the state. Is this in the state? Because their permanent establishment is in another state and they are natural persons.
In case if you take Miss Sona's case, she has a permanent establishment here. She does the activity under the name of.
She does not have a permanent establishment here. She has a
She has a
juridical, not juridical, she has a sole establishment.
agencies and LLC.
Okay. Then she has a juridical person here in
Yeah, but
UAE.
in case of TikTok revenue that she gets, it's coming. She's doing it to this audience, and she is actually selling, like marketing herself, not under the name of agency or anything. So, and then the revenue is coming from Singapore. So in this case, what?
No, no. So that's a disbursement. That's a disbursement.
Actual person
We have to
conducting.
look at the source of the income, not where the revenue is coming from. I mean, I could buy something from you, and the money could come from USA.
Source where the activity is being performed.
Yes. Money, that's the only settlement aspect of it.
In this case, would it be considered as a juridical person or a natural person? Because it's
She is doing as an employee or as a resource of the juridical person. That income belongs to the juridical person. It is being recorded in the books of that juridical person, right? Owner managed company, na? Okay. Anyways, so coming back. So we talked about digital nexus. Which article supports this?
Article 13.
Article
Article 13 and 14 is
and 14 support.
also start of Article 12 because we are mentioning about nexus first in that.
All the art actually it starts from
From
from 11
yeah, from 11,
to
14.
14 support the risk that digital nexus will be taxed in UAE. Am I right? uh, uh, but that a
No, we cannot.
UAE digital nexus will be taxed in UAE.
Can we be so strong like it will be because even the authorities have not issued a statement, so it may
See, okay, is highly likely
to be taxed.
to be taxed in
Yeah,
the UAE,
advise.
right? Agreed? So, uh, right, anyways, coming back to our continuation. This was a cabinet decision. We'll close this. So until what we have covered, yeah,
24.
we did. So the taxability of person we have addressed. If you, now the next stage will be the account level, you know, so the very next thing will be taxable income,
Yeah.
right? That's where we go, basically, yeah. Did we addressed the qualified free zone percent regime as well. So Article 9, until Article 19, all this discussion goes on.
Mr. Alka, this top-up regime also is actually account level, right?
Top up tax regime is, uh,
There is no other aspects.
yeah, we absolutely, yes. But and you could call it account level, yes, because sales or revenue is account level, yes, absolutely. But then it's not only account level, because a multinational enterprise has some basic conditions. The words that are used in that are global consolidated revenue. So that by default means at least two jurisdictions. So if it is only a UAE based company earning, you know, 4 billion dirhams, it might not be treated as an M&E. Why? Because it does not have operations outside UAE.
But just studying the initial structure of the business, can we understand it will come under the top-up regime?
That's why we take the initial information, na? That's, if you look at it, we take, first thing we ask is group structure. The very next thing we ask is geographical footprint.
From that we can identify.
Yes. From from this information and the okay, we can even write the geographical footprint and global consolidated revenue. Now, with at this stage itself, we are able to identify whether there is a chance that this is an M&E under BEPS Pillar 2. Am I right? So immediately we've addressed Article 3 at the outset. Anyways, so then we come to the taxable income bit, right? We completed our taxability as a person thing. In under that we covered too many things. Permanent establishment we covered, state source income we covered, everything we covered, right? Each of those will have to be prepared by way of a slide. Every article deserves the respect of a separate slide if that article is relevant. We don't overdo our work. Where there is a risk, or where there is we want to show that we have evaluated and this is out of the gray area, we can identify on a slide.
Specific, and then we'll mention.
Yes. Yes. Okay. Okay, so now we have come to taxable income. Now we are going to the account level, right? So what is this art? We have Article 20, which gives us the general rules, right? So components are mentioned here: unrealized gains, exempt income, reliefs, deductions, transactions. All of these, when we put in one place, it gives, as a bottom line, it will give you the taxable income. That's the makeup of the taxable income. Hmm. So that's only the general rules. Now, for the purpose of the relevant tax period and subject to any conditions, taxable person that prepares financial statement on accrual basis may elect to take into account gain. This clause 3 is a key clause where we talk about unrealized gains. So we can tax them on the default accrual basis method, or all assets and liabilities, or on a realize. But when we choose to, or we when we consider realization basis, then two approaches are there. Either all assets and liabilities or all assets and liabilities held on capital account, non-current. Okay. So these are the two for real. Do you know where this will become very relevant? In case of insurance business, even in banking business, where, or even in investment business, why? Because uh, investment management companies, funds, they have the biggest chunk maybe accrued mark to market adjustments, mark to market, right? So, like even in case of investment properties, different standards are there, right? So when you talk about investment property, they have a fair value model, which is the default model, and it runs through the current year's profit and loss. So if you're marking to market the investment property to fair value, and all of that is hitting your profit and loss account, you could consider doing it on realization basis. Why? Because it will defer the cash flow.
Okay.
You're getting my point. Now, if you look at the insurance company's financial statements, a huge chunk of that comes by way of unrealized gains and losses. Gains. Even in the OCI. OCI has been addressed separately, where but typically take that part of the OCI, which will never be reclassified to income for the year. Huh. So it is mentioned there, specific. We did this, I think, but when if such a case comes in, if if tomorrow we take on board any insurance companies for or major companies, any listed companies where there are proper disclosures given and all, that's where we can do a mock on any of the listed entities. I think we did for Ala and Ahliya Insurance. You did, right?
I only did impact assessment because I was on the entry level.
So, but now if you look at it, now if you look at the same financial statement, you will be able to take a much better picture of it. Why? Because we've addressed it in detail, right? So, anyways, so that was the Article 20, giving some layout, some major things.
This article itself addresses the adjustments also, like the non-deductible.
There is a In order to explain this article, there is another decision. I think, yeah, Cabinet Decision 134, 130. I have to check, or is it MD 134? I think. Yeah, this is the one. MD 134. Okay, so Ministerial Decision number 134 provides detailed explanations of what to do. Determine, yes. So I'm going to write it here for a quick reference. Article 20 for general rules, right? But MD 134 detailed guidance.
Equity methods and other.
Yeah, exactly. So it addresses a lot of key areas. This
Thing that we will be working on later. So
Yeah,
prepare
but
the
quite quite a bit will be on larger and complex. For simpler clients, probably that level of
So like now small incomes, we don't even have to perform such study on their financials.
yeah, for very, very small incomes, probably not. See, compliance hassle comes into play. If you complicate the things for the taxable person, today you will do it. Tomorrow, if they decide to go somewhere else or insource it, they will be in trouble.
How will we, like, how can we be sure that because this is done by some financial, like some accountant or someone, the whole financial, as when they do the tax accountants do the review again.
Yes, absolutely. And we look at the materiality of the item and the tax impact of it. If it is huge, if it is material,
Yeah.
if it is material, then we can spend a lot of time explaining and all that. But if it is not, if it's like very, very small, then you can tell them verbally that, or even you can write it here, but you can mention that this is immaterial, and rather than, opting for realization basis, for example, it would be much better off for the company to continue with the default accrual method. Hmm. Right? So this ministerial decision talks about many things. So if you look at this ministerial decision, it talks about, after the definitions, first thing is other adjustments to the accounting income for determining taxable income, realized unrealized gains, right? Equity method related adjustment. So by this says that if you are, adjusting the carrying value of the investment in your balance sheet, revert it back to cost method, right? So that's in short, I've explained it.
Like in kind of any investment
Not investment property, investments.
investments.
Investments in subsidiaries, investments in associates, anything. Anything that is appearing as an investment, because then there are classes available for sale, financial assets or otherwise, right?
Something that's different from what IFRS does, right?
Yes, so IFRS, that's exactly this is a divergence from IFRS. Tax is saying, tax law is saying that IFRS is giving you a slightly different treatment. You have to reverse the effect and come to cost method.
Yeah, that's what
Okay.
I'm
So,
confused.
but it will come.
Studying in like
No, but that's what tax accountants are for. See, IFRS financial statements are there with us. In certain places, there will be divergence from IFRS, which the law will ask you to do to comply with the law itself. One example is cost method. Another example is realization basis. Like gains should be, we book gains under the default accrual method. Otherwise, it's a non-compliance with IFRS. But tax law allows realization based taxation. So they say that okay, then adjust it. That adjustment will appear. That's another example is that OCI, which is never reclassified to income for the year. It is, if there is an income which will be never reclassified, it is taxed during the tax period. These are all different treatments than uh, IFRS, right? Um,
not following the
Majority of it is about gains and losses, unrealized gains and losses. Uh, what else is there? Okay, Article 3, other adjustment of accounting income for determining the related party. No, that is, this will be there. And it makes sense also because this is transfer pricing related. We're talking, okay, so this is a topic. Wait, I'll forget. Wait, I have to write this. Transfer pricing. This is a key slide. This is starts with naturally Article 34, which is ALP, arm's length principle.
Yes.
Yeah. Now you were saying.
Here in this case, there's like, if you remember, I think in the Ministerial Decision they have mentioned that according to disclosure of the transfer pricing, they just have to maintain the local file and master file, but they don't have to disclose if their revenue is not above 250.
So there is a full-fledged decision on transfer pricing documentation. 97, I think. This is the one. Yes. MD 97.
So will we do the study on even clients like where the revenue is below the 250?
It is mentioned here. It will make your life easier and simpler. Just go through this very small decision. See, let's read conditions for maintaining master file and local file. What is the requirement first of all? Do we have to do for this for every client? No. Let's read this. Taxable person that meets either of the following conditions shall maintain both a master file and local file. That's what are those conditions? Where the taxable person for any time is a constituent company of a multinational enterprise group. They have written constituent company. It should be entity. But anyways, maybe there is a reason behind it. So where are the definitions? Did they write the definitions anywhere? No. They have simply mentioned constituent company. It can be a permanent branch also. So where they have written it uh, as a term, but I can't see the definition of constituent company here. As defined in it is there. As defined in Cabinet Decision number 44 of 20, refer to the above, that has a total consolidated revenue of 3.15 billion dirham. Global consolidated revenue of 3.15. This is 750 million euros. And to see the meaning of the word constituent company, cabinet decision number 44. Okay, let's check. Cabinet decision number. Oh, कहाँ गया भाई? Okay, maybe I don't have it, but okay, CD 44. Let's have a look at it. Cabinet decision 44 of UAE आ जाएगा. हाँ जी, किधर है? इधर, हाँ, there it is. This concern, ये क्या है भाई? Okay, not 23 cabinet resolution number. This one actually.
Administrative penalties.
Okay. तो फिर ये क्या हम पढ़ रहे हैं? एक मिनट.
Of 2020.
Of 2020. हाँ, yeah. ये रहा. I think this was related to ESR. Okay. So let's first of all read the definition of constituent company. There you are. And it will include permanent establishment, I'm telling you. Let's see. Means any of the following: a separate business unit of an MNE that is included in the consolidated MNE. And they are using the word business unit. They're not calling company or branch or whatever. Business unit.
So it can include anything.
Apparently. Why?
Permanent
There you go. Any permanent establishment pertaining to any separate business unit of the MNE, refer to. So it's clear. So that means what we were looking at, it includes we'll have to save this. Uh, okay. So it's clear now, right? So we can go back to this point where we were. What we no, we were looking at different decision. Where was that? 97. There we go. So constituent company, now we know it includes permanent establishment. Right. So that's the first criteria, MNE. Second, where the taxable person's revenue in the relevant period is
200.
how many clients will come who have 200 million revenue. It will be a fairly large entity.
But why sort of like in smaller cases also there's that related party.
Yes, but in that case, is it mandatory to maintain? No, absolutely not.
We don't even.
We don't have to maintain master file or local file for small companies. If they don't meet either of the two criteria, we don't maintain master file, local file. That's it.
But we'll disclose their related party
There
transaction.
will be a disclosure form in the return. Within the return, there is a disclosure form. And for that, we have to always remember that there is a corporate tax guide. So in this guide, if you look at the last part of it, mm, there was mention of the uh, transfer pricing actually. So
Connected party transaction schedule.
yes, there you are. Name of the related party, transaction, tax residence, gross income transfer pricing method applied. You see, so this is part of the return. Description of any of the transfer pricing method applied, arm's and length value, all of these tax adjustment, all of these we have to provide. Name of the connected person, TRN, payment benefit description, this, that. This is all transfer pricing disclosure. Okay, so it is part of the return under the 16 module number 16 within the corporate tax return, module number 16. This is all related to transaction and connected person schedules. So for small entities, we will have to do this only. Okay. Anyways, coming back to where we were, uh, where did we start from? Okay. Is it? Yeah. So there was what was the MD 97? MD 97 on TP documentation,
Yes.
right? And corporate tax guide on TP disclosure. Yeah, this is what module 16. Okay. Now, if there is other things like detailed um, disclosure and a proper compliance with the transfer pricing, for that we have a different thing. Do you know what that is? Transfer pricing. This will be, I think I have. Okay, let's see. Yeah, it's in Word format and it has too many, like it's 140 pages or something, but it contains everything on transfer pricing. Okay, this is and very interestingly, if you really think about it, a, a question should come that is this, it's a guide, but is this part of the legislation? That's a question, right?
But if we don't have any ministerial decision, cabinet decision, then finally we refer back to a guide itself.
That's intuitive answer. What we do is we look at things which are not intuitive.
We
We
must have quoted here to refer back to.
Where are we? 30. Let's go to 34. I will show you. Let's see. There is a mention. Uh, there, I can tell you that. No, this has been mentioned actually in one of the clauses that there will be a decision or they will issue guideline. Maybe it is in the uh, uh, what the we were looking at a decision recently, if you remember. Uh, Transfer pricing documentation, MD 97, right? We were looking at MD 97 earlier on. So MD 97. I remember that they have cross referred to a guide or something. Uh, that's the one.
The authority shall issue guidelines for the applicant.
You see this? So guideline has been alluded in this decision, ministerial decision. So that also provides us a basis to refer back to the guide. And chances are there will be more references that will be hidden within the guide, the cabinet decision, ministerial decisions. So this is the only framework that we have. The transfer pricing guideline issued by the Ministry of Finance. This is the only reference point that we have to comply with the transfer pricing rules. Not only documentation, but treatments also, or the what to follow. So, anyways, broadly speaking, we have written, that's like we have taxable income. We then immediately after that, the other articles are there which are for uh, what do you call it? Disallowed deductions or something.
Exempt income.
No, yeah, exempt will be there. So taxable income, exempt income. Within the exempt income, that question of dividends will come, participation
Exemption.
exemption will come, right? Etc. What else is there? Let's have a look at the decree law. This is decree law, right? So we were on Article 20, right? This is a clean sweep we are doing. Nothing will be left to chance. 21 we addressed, small business relief, right? Then Article 22 is exempt income, right? Right. This one was taxable income. Why didn't we write Article 21? Because that's a small business relief. We have covered it up there, isn't it?
Yes.
That's where we covered it. Where?
In exemptions, specific exemptions.
Specific exemptions. Yes. So yeah, that's where we covered it. So right, what else is there? Okay, exempt income, different types of exempt income has been identified. Dividend and other profit distribution, dividend, then participating interest, FPE has been covered, right? Income derived by non-resident person from ships and aircraft. That then the most complex article of the entire UAE corporate tax decree law, Article 23, participation exemption, which when we actually find out is not very complex. The language is very complex, but going into it, so we'll have to give separate time to understand the wordings of it. It will take some time. It just to read this article, it takes time. So participation exemption is Article 23. Did I already write this?
You didn't put the article.
Participation exemption is Article 23, right? uh, what else is there? Okay, actually I should not be doing it like this. Dividends, participation exemption. What else is it? FPE we already addressed. Foreign permit establishment. What else? Non-resident we covered, right? Then we come to reliefs. So what different reliefs we have? One is called the qualifying group relief, right?
Yes.
So we can say qualifying group, which is Article 26.
Yes.
So what is the concept of qualifying group relief? 75% shareholding.
Yeah.
Common shareholding or one parent subsidiary shareholding, right? Third entity or person holding 75 or one entity holding 75 directly, right? Conditions are provided, none should be exempt person, qualifying free zone person, etc., all of that, in order to exploit this relief, shall not apply within 2 years. So all these conditions have to be read. Then we come to another thing.
Business restructuring.
Yeah. Now what will be this business restructuring relief? Article which? 27. क्या है ये? What exactly is it? Like transfer as a going concern हो रहा है ना अगर, then it will not be taxed. Basically, that's the idea. No gain or loss taken into account in any of the following. Taxable person transfers the entire business or independent part of the business to another person who is either taxable or will become taxable. तो उस पे हम gain loss नहीं record करेंगे.
That transaction.
हाँ, so that transaction remains out of the scope. It's not a taxable transaction. one or more taxable persons transfer their entire business to another person, right? This is a business restructuring relief. Acha, what else is there? But
So the flex, so when we are preparing a return, we have to elect for this relief specifically, like in the return, or like
in the
it
return, we okay. So there is a proper, chapter here, module here, business restructuring relief. There you go. So this type of a question will appear there. Did the taxable person transfer a business or an independent part of a business during the tax period under which business restructuring relief may apply?
okay after.
Yeah, so we have to give an answer.
So but in this case, suppose like
And that's it. Only two questions. Would the taxable person like to make an election to apply for business restructuring relief? So answer to your question is yes, there is an application question here.
so that now this is going to be done by the new taxable person, right? Who actually purchased the going concern business.
See, okay, hold on a second. What do you mean by new? Okay, today we are filing the return of one company, XYZ company, acquisition. Oh, for example, there was no business restructuring done. Next year they actually do it.
Hmm. No, what I'm
It
trying
can
to say
happen in any year.
sort of like after corporate tax registration, suppose like after 2024, this in 2025 they have transferred the business to the uh, new taxable person.
Hmm.
So this now the business now when they're filing the corporate tax, it's gonna be this new owners gonna be, file the tax. But the financial transactions, everything was under the previous ownership. Who's gonna file? Who will ask for the business leave? The new taxable person,
See,
because that transaction is going to be in the books of the like before in the previous one.
how does what is the accounting entries or accounting treatment that is done when this type of a restructuring happens? This is the question to ask. We have to read the wordings that are described here. See, this is business restructuring. Na? When a taxable person transfers entire business or an independent part of the business to another person.
Hmm.
They're talking about the business.
Yes.
Person remains there. In case of one investment company which was actually listed on ADX, we did this. So their entire assets as well as entire liabilities were transferred to another person, and proper board resolutions were passed. We drafted the resolutions, everything, right? So if because of this transfer, the money consideration that is received is higher than the book values,
There's a game.
there's again that the transferor should ideally record, right? That gain will be out of scope. It will be recorded in the books, accounting books. In the tax return, it will not come. Why? Because this business was transferred as a going concern. Yeah.
Yeah, that's what. But Mr. Altaf, like you said, now you showed the return. We have to. There is two questions, right? Whether the person has like there's a restructuring relief is applicable or not.
Hmm. This
The
question you're
under which yeah may apply or not. In this case, this question is answered by because the gain has been recognized in the pre.
this person who transferred their business as a going concern to another person has an option. They can either say that we don't want to take the business restructuring relief, or they will say that we want to take this relief. Now think about it. When will the person want to take this relief? Only when there's a gain.
Yes.
If there's a loss, why would they want to take it? They'll say, oh, we incurred a loss. So they will not go for it. If there's a gain, they will not want the gain to be taxed,
Mm, okay.
and they will opt for it.
That means, Mr. Altaf, even though they have transferred a part of or like one going concern business, they have the remaining. They're still under their taxable person.
So that's why the wordings were important, which I showed you earlier on. It's entire business or an independent part of its business.
So entire business now, this person is no more taxable.
This person is existing only as a shell company.
Yeah.
The entire net assets have been moved to another company, but the legal vehicle is there.
So they still have to file corporate.
They have to. Legal vehicle is there. TRN is still active. Business has gone away. Net assets have moved to another company, another taxable person. That's what it is.
So they still have
Yes.
they have to apply or not. That's it.
A clever, I wouldn't call it clever, but anyways, there is one of the things like transfer entire thing to another person and immediately file for liquidation. Then file for liquidation.
So that wouldn't this actually result in, like, if they are trying to tax avoidance?
No, but the law is giving them the benefit.
It's a loophole, right? Like they
There's no loophole. So think about it this way. There is a gain, major gain, right? So there is only two options now. They will either immediately liquidate after transferring the business, or they will stay they for take their own sweet time to liquidate. They're okay, let's decide what to do next. In 1 year we will liquidate, or we should liquidate soon, and the time, right? Either scenarios, they are safe.
okay, Mr. Altaf, they are not liquidating now, but like now they were taxable at the threshold was high. They had a 9% charge on, but at this time they have done part to a different person, part to a different. So they have actually split their business in such a way that both the businesses come below the threshold.
So as long as to the point, it's a simple answer actually. In your books, the answer is available. The books contain the answer. By to the point of transfer, whatever incomes and expenses were there, they will stay in the books, right? You don't transfer the profit and loss account to another company, right? You transfer only the balance sheet. P&L is still there. To the date of transfer, whatever was there, they will have to be subject to that, to tax on that part. Going forward, I mean, once they have transferred, they're not earning income.
If they gain like higher gain on both, this can, what if it can cover the exemption can actually reduce the tax payable?
So these are the this is the way a corporate tax strategist should be thinking. In our first 6 months while we were in business, there was a solid gain, solid profit. And when we transferred our entire business to another company, that resulted in a loss. Now, what is beneficial for us? Should we take this regime or should we not take this? If we take this regime, we lose the loss benefit because that transfer goes out of the scope of corporate tax. So we lose the benefit of the loss. But if we don't take this regime, then that loss will come to our books and our 6 months profit will be offset. That is strategy, right? So you and the client will not know this. You are the one thinking on behalf of the client as a strategist, and we take the call. We advise them. We don't take the call. We advise them, put the scenarios in front of them, and then, but again, there may be other variables, larger, many things. That's why it is a chess game. Okay. Anyways, coming back, what was yeah? So Article 27 we talked about business restructuring relief, right? So and that I have mentioned. So you see this? It's quite a long article.
Then deduct.
Then we come to deductions. So until reliefs we had mentioned, right? Did we address all the reliefs? There is one relief that is left. It will come later on, and that's tax loss relief. I don't know which article is it. Double check.
Article 37.
37.
But it's coming under tax loss provisions.
Tax loss provision. So yeah, but we'll come to that. I've just written it. We'll come to that, and we'll find that it is still a relief. Basically, it's very simple. If you have a brought forward tax loss, you can offset it. That's it. That's the relief. So this is consideration of the relief. So that what, yeah, BRR we did. What was the next one? No, 28 deductible yeah, so we come to the deduction. So first 28 is only, it talks generally about various deductions that are there. It tells that it should be done for wholly and exclusively for the purposes of business. This wholly and exclusively is something that a novice would ignore, that we have to that's a cross check. So it should be written very clearly that when we are looking at deductions, we should specifically look for the wholly and exclusively criteria. Getting the point?
Sort of in this case, does this have any implication? Like in VAT, we have, even if the expenditure is like incurred for the business, but if it is not invoiced under the business name, we can't consider it.
Sorry, say again.
Like in this case also, does it have just like in VAT, if it expense might be incurred for the business,
Hmm.
but if it's not invoiced under the name of business, we cannot use it. One second.
Okay, so let's quickly that.
Like in a CT return also, is there something like that?
So uh, the evidence is needed, because otherwise everyone will start booking fake expenditure, right? So evidence is a common sense criteria.
Look, in that case, many of the businesses like small, there are so many expenses are there that actually doesn't have under the company's name, but then they're actually incurred for the business.
Yeah, so the point is that if such a thing happens, uh, audit is a good criteria. When you do external audit, they also look at things, right? And that this is a place where corporate tax law and independent external audit are aligned. So auditors can determine or give an opinion that, okay, this expenditure, although the legal form of it is different, but the economic substance of it is correct. Substance over form, right? So this is we have concluded that this was incurred for the purpose of business. So that's where FTA should ideally accept it.
So first, if we see that materiality of the expenditure is having this issue, then we have to request the client for an external auditor's report on that.
No, no, no need for that. There can be other means as well. Na? External auditors do not issue reports on individual items.
No, they to audit the financials in that case.
So if you have an auditor's report, by default, auditors are saying that we have concluded that material in all material respects.
The company audit, like I know you have told most of the
If
clients.
they are not, then yes,
Yeah,
then we
that's
have
why I
to
asked. That's good.
then we have to do either of the two things. If they don't want to audit, then we have to advise them that, okay, since you're not auditing, we feel that from an FTA perspective, if you have sufficient appropriate audit evidence, which is the lingo of the ISAs, right, then they will accept it. So provide us sufficient appropriate evidence that this business was incurred for the purpose, this expense was incurred for the purposes of business, wholly and exclusively for the purpose of business. And if they can provide that basis, then fine. We can advise them. We are not auditors. We don't confirm anything or deny anything in absolution, but we can at least tell them that it is highly likely that now this expenditure will be accepted. Why? Because you have provided uh, the audit evidence that is likely to be sufficient and appropriate.
Most of our clients, in this case, we have a conflict of interest here because we do their bookkeeping and then we become their tax accountants to file the returns. And if we ask this thing, they counter back saying that you're the one doing the.
No, so what we are doing is we are booking the results of a transaction already committed by you.
Yeah.
Does that make us responsible
No.
for doing the transaction? No. We will record whatever you give us to record. And if we feel that this is not sufficient and appropriate or mutually and exclusively for business purposes, or it will be seen in the eyes of the FTA as such. We feel a duty as tax advisors as well to tell you that this is going to be a non-compliance for you. Better organize it. And what is the final way of organizing something? You did an expenditure, you can't even report it, but you know this is for the purpose of business, right? Legal form is different from legal form suggests something else, but economic substance is there. And so, what do we advise them? We say, look, prepare a basis for that. It seems like you have done actually for the business, but maybe prepare some sort of a working justification, some basis, some indicator, which will convince or inspire the tax auditor to believe that this is for the purpose of business, right? Uh,
Ask us to do.
no, so we can advise them. No, they go, we don't do everything. It's impossible.
Facing this first time, like whenever I advise something on
Give
that.
me scenario and then I can give you the answer.
Okay, so that now we have a lot of transactions like in online, Amazon, Talabat, and things like that. When we don't like according I'm understanding based on what they are saying that okay, this is for business because they
Verbal representation. Okay, so for all of the marketplaces, Amazon, Talabat, this, that, you should be aware that in marketplace there is always transaction history available.
Mm.
For every transaction that they have done or purchased, the history is available.
Yeah.
So if taking that history or a snapshot of it provides us only that evidence that this transaction actually took place.
Yeah.
Up to this point, to this extent, it is not an evidence of wholly and exclusively for the purpose of business, right? Now, 50% we did, proving that this transaction is not a fake transaction.
That is
It actually took place.
yes.
Now comes the second part of it, that this was incurred for the purposes of business. So there, in the ordinary course of business, you will find millions of instances where management representation is the only thing
Yes.
that will be the basis to say that this transaction happened for business. Like take the example of entertainment. You booked an entertainment expense of ice creams. We took 50 ice creams, right? Now, how in the name of God any possibility that the auditor after 6 months will be able to see that all the 50 ice creams were eaten only by employees? Impossible,
No.
right? You have to be present there and counting. You're the employee, you're the employee, you're the employee. You can't do that, right?
No, we can't.
The only way to do is to accept the management representation. There's no other alternative. And this is practical scenario. So any consumption for that matter, for which you have no other option to verify, right? Unless it is so material that you are afraid that it might, number one, it is a material transaction or material class of transaction. In audit, we look at such transactions in two ways. One is the individual instances, which may be far below the audit difference threshold as well. So when we look at the significance of any item in audit, there is something called a materiality threshold, right? Then half of it is called tolerable error. Half of it, or maybe some give or take, it's called that if some material misstatement or error has happened, then it affects the presentation of the financial statements. We don't condone it. But if it is tolerable, it goes to the tolerable error level, then we can still issue a clean opinion. And then there is even below that, it's called, in some big four, it's called SAD, Summary of Audit Differences or Audit Differences. These are very minimalistic, small scale transactions where we have found some error or other problems, right? So what do we do in that situation? We collate all such small transactions and we take a summary of it. That's why it is called summary of audit differences. And we look at the summary total of it, whether it touches materiality or not. If it touches materiality, then there is a problem.
Yeah.
Then it could have been a very carefully planned fraud or misstatement. And this, I have in my personal audit career, I have uncovered it more than once. In case of a microfinance NGO, I uncovered a fraud. Small broken down items twice. In case of two NGOs, one was microfinance, one was another one. They like distributed it by dividing it by 1000.
Most of the when you're doing auditing, like in sample basis, how do you figure out such minute?
Analytical procedures. That's why I told you analytics is the biggest power.
When you see the pattern.
When you see the pattern. Uh, in 2008, no, 2009, 8 or 9, in those days when the technology, audit technology was still booming, EY had introduced a tool called GAT, Global Analytics Tool. Naturally, now it is extremely advanced, but that GAT tool would connect with the system of the client or the accounting software of the client, and it would import all the data of the client transactions. And then we would run analytics, like we would run search strings like ADJ, because wherever this type of a fraudulent bookkeeping is done, misrepresentative or covering up, so they would use this strange nomenclature, ADJ. It would reveal all the ADJ, all the transactions with the description ADJ. Now you can, my dear, what is going on? You have like 5,000 ADJ transactions. What does this entail? And you would find out sometimes similar pattern, maybe the transaction landing in the same types of accounts, like that, or complex entries, scheme of entries, reversal, adjustment, this, that. So, ADJ or REV reversal, ADJ, REV, etc., etc., etc. Uh, these are indicators. Sometimes you can, and through analytics, you can identify, right? So, there are 100 ways to identify these. Now, with the machine learning and AI and all those, it has become 1,000 times easier to identify such patterns. But we do it manually, fine. Even on a manual level, you can apply, in the Excel, you can develop pivots, you can apply filters, and through that you can track and you can identify patterns. Anyways, coming back. So is this clear?
Yes.
The whole exclusive and this that we've discussed. Expenditure is incurred for more than one purpose. Deduction shall be allowed for only the relevant part, right? Identifiable part, appropriate portion. Then next articles 29, 30, and even the later one, 31, specific interest deduction limitation. These are all for interest until 31. And they,
General
yeah, general. So
interest.
yeah, so some modifications came in here. So I'm just saving time by telling you quickly. Like in the initial time, it said 30% of the EBITDA. It did not specify tax EBITDA. Later on, some decision is there already. You can go and check into it. That decision clarified that it's not just EBITDA, it's tax EBITDA, 30% of tax EBITDA. So that's there. Then the safe harbor also came, like up to 12 million dirhams interest expenditure, net interest expenditure is allowable. So when we start looking at interest expenditure, we don't think twice. We just first of all say, well, how much is your total interest expenditure? Well, there's around 5,000, 10,000, 100,000, 500. It will never reach 12 million. That's a huge threshold. A listed entity, maybe, yes, with billion dirham or more in revenue, or 2 billion dirham, yes, it makes sense. Maybe they will reach 12 million dirham in net interest expenditure. Imagine, highly leveraged company would be. But for SMEs, forget about 12 million, they will not reach 1 million.
So there.
So yeah, yeah. Let us quickly write this. So, to make our lives easier, uh, the first question ideally we would be asking is safe harbor. AED 12 million. You will not even waste a single minute of your time. You'll ask how much total interest expense is there in your books. They say, sir, it's only 50,000 or 10,000 or whatever it is. Too small to even waste your time on. 12 million dirham is the threshold. Okay. Okay. So, yeah, then after that, world famous. Probably the only thing everyone knows is about entertainment expenditure, right? Everybody knows. So, entertainment expenditure, the 50% rule. I'm not even going to write more, right? Everybody knows it. What is this 50% rule? Uh, okay. And the staff 100%, others 50%,
50%.
right? Then we come to non-deductible expenditure. Was I already writing? No. Non-deductible. So non-deductible also, interesting article, important article. What are no deduction allowed for donations, grants, etc., other than qualifying public benefit entities. You should read this article. They are they are those entities which are listed in a cabinet decision. Qualified public benefit entities are listed in. Yes. So if you have given the donations, etc., to a qualifying public benefit, only then you will get the deduction. Fines, penalties, other amounts awarded as compensation for damages or breach of contract, no deduction. Even breach of contract. You see this?
Yeah.
Even for that, there is no deduction. Bribes, illicit.
Because like the first one,
Hmm.
it's to a exempt person. The same way, if a fine is paid to a government entity, still it is.
Read and tell me. This is a question asked by many people on the Sync GCC platform also. Fines and penalties other than amounts awarded as compensation for damages
Okay,
or
so
breach of contract.
it's
Yes. No specification for government. Okay. Now, one more interesting. Okay, dividends, naturally, dividends are not deductions, right? They are appropriation of profit. Amounts withdrawn from business, these are drawings. Drawings are not, deductible. This is an interesting thing. Corporate tax imposed on a taxable person under this decree law.
yeah.
So this is not a deduction. This is it's a different thing. This is due. Uh, on a taxable person under the. What about if you have been if there's a withholding tax on your foreign payments,
Then
foreign collections?
withholding tax.
Yeah, but that's for withholding tax, Article 49, and then there is a foreign tax credit next. I don't know, 44 and 45, I think. So uh, we have, but what is this?
If it's withholding tax, that is like
No, but what is the meaning of this sentence, first of all?
corporate tax, and I mean probably for the next year. The
Nahi bhai, this is a very simple sentence.
yeah,
After making all your taxable income, how much amount of corporate tax comes that you have to pay to FTA, right? That is
payable.
not a deduction.
Obviously, instead of
Obviously, na, but they had to write it in the law. We know it is not, but some intelligent people might try to deduct that also as an expense.
maybe that's what Mr. Altaf in the subsequent years to come. Because after you pay this, this will show as like the accountants will
It will not. It will not be allowed. That's what why it is said it.
That's why probably to not create the confusion.
Yeah, but you don't have to wait for the second year. You can do a provision for taxation during this year, right? Uh, Anyways, input value uh, added tax incurred by a person that is not recovered, blocked VAT. Okay, tax on income imposed on taxes outside the state.
So
Yeah. Remember what were the reliefs? Double taxation reliefs. There were three modes of double taxation relief. They have been specified in Model Tax Convention of OECD. Three modes. What are those?
One is tax credit.
Mhm. Meaning, you have been deducted tax or applied tax in another country, and you are taking a credit here in this country. That's so. In order to take that credit, you have to include the foreign income here.
Yes.
Correct?
Yes.
Okay, that's one mode. What is the other mode?
Then one is a withholding tax.
Right.
No, that is the same.
Same thing, no? It can be withholding tax. It can be filing of the return also. Branch is still foreign in case of foreign. See, please understand. Foreign operations can assume at least two different shapes. You will either set up a branch or you will be doing exports without a branch. Correct?
Yes.
In case of exports, you will incur what? Withholding tax. Usually. Correct? In case of a branch, it will be different.
You will pay tax there.
You will be properly taxable there by way of a branch. Correct? So there will be a return there. So,
That's what they will take it as tax.
so withholding foreign tax credit will come in both cases. Whether you are exporting and you are facing withholding tax deduction, there will be a foreign tax credit consideration. Or whether you have a branch in a foreign country and you had to pay taxes there by way of proper returns, etc. Still you have a you can claim a foreign tax credit. Both ways foreign tax credit is likely to come or it can be considered, right? So for foreign tax credit was one method. In both cases, the income will have to be recorded or reported in UAE, whether it is exports, whether it is branch income. Both you will have to include here in order to claim foreign tax credit. Correct? Okay, that's one thing. What other two modes are there? What are we discussing here? Double tax relief. Relief. How can a taxable person get a double taxation relief? First method was foreign tax credit. What are other two methods?
Is it that they will seek for relief in the other? No, the percentage difference.
Foreign permanent establishment exemption.
Yeah. Okay. Yeah, we discussed that one.
That's the second type of double taxation relief. One is either use the foreign tax credit method or
The foreign
permanent
establishment, I think.
exemption method. Agree?
Yes.
So if your foreign permanent establishment qualifies for this exemption, in certain cases it will not qualify. You remember? In certain cases, you want to claim that exemption, you will not be able to.
Percentage is low.
Percentage is lower, correct. What is this? Milk coffee?
Yeah.
Milk coffee, huh? Acha. Jeline, are you mad at me? Why did you give her milk coffee and not me?
You asked for Turkish
I
coffee.
don't remember that. Can you please give me some milk coffee, please? Thank you so much. Acha, two methods we've discussed. What is the third method?
That they will ask seek for exemption in the foreign country.
Right? Exemption to foreign permanent exemption होगी ना?
Yeah. What if they
When we talk about double tax relief, we talk about our country. We don't talk about the other country.
is it the countries that
In our country, in the country which is being discussed right now. And the third method is a dumb method, idiotic method. Whatever tax you paid in the other country, you treat it as an expense and deduct from the taxable income.
but you are not supposed to. Okay, because it's a different. Okay. Yeah, they have not mentioned that only their decree law they have mentioned.
To curb that from happening, paragraph 8 is here. Clause 8 is here.
Such other expenditure specific
No, clause 8, tax on
income.
income imposed on a taxable person,
outside the state.
you can't claim it as a deduction.
Okay.
The only thing you can do is claim it as a tax credit. Or foreign permanent establishment basis, uh, those affairs will stay there. Our affairs will happen here. That's it. Foreign permanent establishment. It's like China wall between foreign operations, domestic operations. So this is what else? Such other expenditure as specified in a decision issued by the cabinet at the suggestion of the minister. Okay, so there will be a decision again for non-deductible expenditure. So disallowed expenditure has been addressed in Article 7 of MD 134. Okay. Okay, fine. Coming back, what else is remaining? So we have gone to non M array MD 134, right?
Non.
Uh, and MD 134 Article 7, particularly, among other things, right? And naturally,
The
non-deductible
Article 33.
Article 33. Chalo, हो गया? Okay, what else is there? Anything left? I can close this. Close this. Uh, Yeah. So yeah, then after that, then we have arm's length, which is transfer pricing. Three things, right? 34, 35, 36. 35 is related parties and control. Very, very important. You should know what is control, right? Uh, Many things are there. We should go through this. Then we have connected persons also. So various, these are the interesting officer. This word is a very interesting word used here. A director or officer of the taxable person. Whenever we talk to the clients and tell them your CFOs should also be careful. This, and we are talking to the CFO. CFO becomes like very skeptic, afraid. Huh? Even I am considered in this. Yes, you are, because you are an officer.
So the payments, as in not just salaries, right? Even commissions,
That is why they have used a very clever word.
payments, any kind of.
Yes. Okay. Then we come to this 37 tax loss relief. Tax loss can be offset against subsequent period.
So in that case, do we consider the loans given to the shareholder?
They will also come into question, like because there is a money value there. Even the time value of money is important. If you're giving money, okay, fine, he will return the money, he or she. But the question is time value of money. Is for like, is this normal course of business? Is the company even allowed to do that? What is the company? 100 questions will come in when you're looking at transfer pricing angles, because there are various risks.
But there is no interest applied on that. Then why
Interest not applied on that.
there is
What
no
do you mean by that?
interest?
To staff loan?
No, to shareholders, loan to shareholders.
Loan to shareholders. So exactly, that's what, see, for a few things we need to consider. Shareholders, if they are taking a loan, and if they're not repaying interest on top of that loan, big question mark. There's a transfer pricing adjustment that will come into play. Loan to shareholder. Okay, we'll see. But that's the point. See, the substance, the rationale will come into question. And from everything converges onto the same point. Are we avoiding tax? That's the question that we will always ask. Are we evading tax or avoiding tax? Thank you so much, Jaleel. You're a lifesaver. Okay, right. So, Claire, tax loss relief we already addressed, right? Where did we address it? In reliefs. So it was already addressed. So, okay, sorry, where the hell is it? Yeah. What is next? Transfer of tax loss. This goes together with the qualifying group.
of transfers and qualifying.
Exactly. Now,
No, then what about tax group? So that
yeah, that's what I'm writing. Uh, Tax group versus
qualifying.
qualifying group,
Mhm.
right? So we have to look at both scenarios. The uh, you know pros and cons. We should know what are the conditions of tax group. Can we transfer tax loss in qualifying groups? We can. In tax group, by default, it is offset,
Yes.
right? But in tax group, we lose the threshold. Multiple thresholds we lose. Qualifying group thresholds remain.
Threshold remain?
Zero rating threshold,
Yeah.
375K. For each entity, 375K remains. In tax group, we lose. Only one threshold is given.
Yes.
But
But
in qualifying group, one more thing comes into play, transfer pricing. Any
yes.
transactions between qualifying group entities will be subject to transfer pricing. In tax group, it will not be change of pockets, right? So Article 38 is also covered, right? Art- Article 38 for qualifying group relief. है ना? What was the tax group article?
40, Article 40.
Hmm. 39 is what? This is limitation on tax loss carried forward. 39 was for
Limitations.
it was where did we write reliefs? Here, tax loss relief 37 and 39, because this is the maximum we can carry forward. Sorry, we can offset. Limitation on tax loss carry forward can be carried forward and utilized in accordance with the provision of Article 2 of 37. I mean, actually, this has more to do with the offset.
Instead of in problem with tax group, it should be for sure parent and subsidiary itself, right? Only then they can create tax group.
Tax group, yes, 95%. 95% subsidiary.
Not like what if it's a connected party and there is
What do you
percentages
mean by connected parties?
like a related party? What if the shareholders are same in both the companies, two companies?
No, doesn't matter. The legal structure must be that of a parent subsidiary.
That's what I was.
It is written in the tax group. Has to be a parent subsidiary relationship. It cannot be common shareholding or related party shareholding. No, it will not. 91% holds at least 90 voting rights in subsidiary. Okay, so that's Article 40, right? So where was that?
And forming the tax are not a mandatory thing, right? It depends on the taxable person whether they want to individually file or.
Yes, tax group, Article 40. Okay, that also done. What else is there? Key things we have almost date of formation and cessation. So 41 is there. Taxable income of a tax. So 41, 42 is there. What else is there? Um, yeah, that's about it. So 42, 42. This is all for tax groups, right? Then the administrative side comes, currency, right? For the all amounts must be quantified in UAE. Exchange rate, क्या था? Converted at applicable exchange rate or central bank.
Instead of in reliefs, we can mention the foreign tax credit and withholding tax credit also in reliefs.
Double tax relief. It is a double tax relief. So did we mention already or not? Hmm. So foreign tax credit article
Article 47,
47. What else you were saying?
withholding tax credit.
There is no withholding tax in UAE.
Yeah, it is not there, but there's an
Article,
article there specific.
which is Article 46?
Yeah, 46.
Yeah, so okay, fine. We can write 46, 47. Okay, like that. So,
Oh,
so what else? Anything else? Withholding tax we mentioned, withholding tax credit we've done for. अच्छा 45 से स्टार्ट हो रहा है 45 तो वी शुड नॉट राइट कहाँ गया 44 क्या था हाँ कैलकुलेशन सेटलमेंट ऑफ प्रॉफिट
Settlement of profit.
so this is procedural uh, okay then what next payments now this is all procedures corporate tax payment refund and then the GAAR is a very important aspect GAAR we can write it
Under exemption.
so this thing qualifying tax acha, this is so GAAR we can what were you saying under what
The exemptions.
not exemptions it's a GAAR is something that will move along the entire corporate tax
Okay.
okay GAAR will move along it will hit in taxability as a person it will hit under
Taxable
income taxable income deductions everything exemptions okay GAAR is an overriding principle in short anti-tax avoidance
Understood. Like so, while we are doing it simultaneously,
we have to keep an eye on where there is an effort to avoid tax and alert the shareholder. Okay, so this is all GAR, timing of transactions. This is all guidance, substance, timing, this, that. Okay, registration, deregistration. Now that's another angle that needs to be addressed, right? Uh, what was the art? What is this GAR article number? 50?
it's
50.
yeah, 50.
Okay. Then okay, registration, deregistration is then returns and clarifications. Now these are see rest of it is procedural, but for example, they have mentioned return filing, etc. But there's one or two key things. Okay, so like for example, this article, this financial statements, that's on the compliance side of it, right? So there is a decision also available which identifies 50 million dirhams and all, right? So audited financial statements, that decision must be complied. So EFS, ठीक है EFS आएगा ये आर्टिकल कौन सा था 54
Financial statements.
54
Yeah, 54.
हाँ अच्छा और क्या है जी ट्रांसफर 55 तो ये बहुत बड़ा डॉक्यूमेंट है टीपी डॉक्यूमेंटेशन आर्टिकल 55 बहुत बार रेफर हुआ है क्वालिफाइंग फ्री जोन पर्सन में भी आया है
Yes.
राइट the record keeping will that record keeping 56 you know what is the statute of limitation कितने साल लिखा हुआ है
7 years.
डिफॉल्ट क्या है यूएई का 5 years टैक्स में 7 years है ठीक है और भी है बल्कि आगे एन एग्जम्प्ट person maintain or enable to be readily certain by for a period of 7 years following the end of the period into which they relate right then tax period आ गया tax period means tax year ideally but it can be different as well जब especially जब liquidate कर रहे हैं deregister करना है it can be less also change in tax period ये important है it one can choose a different period but GAR will be there you can you want to choose a tax period that starts from let's say 5th of June just so that you can avoid a full year from tax that will be a question mark okay so article 59 clarifications is person may make an application to the authority for clarification decree law adverse advanced pricing ये जो advanced pricing agreement this serves in transfer pricing. Make an application for a clarification regarding the application of this decree law or conclusion of an advance pricing agreement with respect to a transaction arrangement proposed or entered into by the person. There is a fee involved for 2000 dirhams or whatever it is, but it is there on the FTA website. And so Article 59 we should write here. कहाँ था हमने transfer pricing? Where did we give? Here. Uh, Article 59 for APAs, Advanced Pricing Agreements. And not only APA, you see this? इसमें इन्होंने restrict नहीं किया APA. Interpretation of this decree law regarding the application of the decree law or the conclusion of an APA. So you can ask for other matters as well. Okay, then what? Violation and penalties. Now these are all like penalties. Key thing. If we have one very important slide in the impact assessment is penalties. If if there are violations that are cited or possible violations, it can attract penalties. Okay. Now this transitional rule, for the first time, you're filing transitional rule. What was it? Article 61.
Yes, true.
So this we have to tell them that your opening balances. There is a decision also for the transitional provisions. Opening balances at fair value. You understand what,
Yes.
this was identified and this explained in decision as well. In the there's a ministerial decision as it is alluded. What else is there? That's it. Closing. So that covers your this Article 66 international agreement also has something to do with double taxation. To the extent of the term that is in force in the state are inconsistent with the provisions of decree law, the terms of the international agreement shall prevail. Do you know what? Vienna Convention, Article 66. So so DTAs applicable. So here the Article 66 upholds Vienna Convention. This is the requirement of Vienna Convention, that if there is a international agreement under Vienna Convention, it would prevail the domestic law. Application of decree law period, and that's it. So that's about it. Okay. Based on this document now that I have prepared, I'll just write it as work program for impact assessment. Okay. So based on that, we will have to prepare the impact assessment. I will just share this. You can go, please. Thank you.